Be careful. Spread your risk. Don't put all your eggs into one basket. Diversify. That's what everybody's telling you. But maybe there is a bit more nuance to this. Because had you bought just the top 10 cryptocurrencies 10 years ago, you would have underperformed just buying Bitcoin with every single of those assets. So maybe spreading your risk isn't always the best. On the other hand, you also don't want to be the person that puts all the eggs into the Dogecoin bet, right? There was this Dogecoin master that then loses all of the funds. So how much diversification is justified? When is it justified? What's the pros and cons here? How should we navigate this? Should we be all in on something that we believe? Or should we spray and pray? There's pros and cons. And there are different ways to diversify. You want to diversify, you want to spread your risk across assets that have a very low correlation to one another. In other words, when one asset goes up, the other asset doesn't necessarily have to go up. And vice versa. When it crashes, the other one doesn't necessarily have to crash as well. And the best way to achieve this is to spread across asset classes. So you don't want to diversify within one asset class, as in I buy 10 different properties and hope that this one property that I buy will not collapse. Or you don't want to buy, say, 20 different stocks and say, okay, because I have all these 20 stocks, I'm way better diversified than just buying one or two stocks. And the same for crypto. You don't want to do that. You want to maximize the correlation inefficiencies, as in different markets behave in different ways. So you want to be diversifying across asset classes. You want to have crypto, and you want to diversify that crypto with stock. If you've got stock, you want to diversify this with property. So different asset classes have low correlation to one another. So you want to buy different asset classes, but you don't want to necessarily buy a lot of different assets within one asset class. Because in the end, diversification is nothing else than an insurance that you're wrong, right? So you maybe necessarily don't have an edge in every single financial market, right? Maybe you don't know the property market that deeply, or maybe you don't know the stock market that deeply. Maybe you only know one of the markets well. And that's maybe the market where you want to have very high allocation, very high concentration. So you know one particular market, you know in that particular market that this specific asset is especially good, and that's where you want to have high concentration. And the other asset classes, which you still want to own because of the low correlation, you want to be spread wider, because there you don't necessarily have the market edge. There you cannot necessarily beat the average. So there the only aspiration should be to simply just go with the average. So the way to look at this is, when you understand the market, then your very best investment is probably much, much better than, say, your 5th or 10th best investment. Right? Because you go through all of those different, say, properties, and you say, okay, I really believe that this particular location in town will do well, and within that location, this particular house or this particular housing complex might do well. And then you go really deep on that, and then you invest heavily in that. But if you don't really know what, then you could simply, and you don't have an edge, say, in the property market, and the easiest way is to simply just buy small apartments all across different towns, maybe across different countries. Same is true for the stock market. If you don't have an edge in the stock market, simply just buy an index ETF, a low-cost index ETF, Vanguard or QQQ, whatever it is, right? You simply just get the market return, and do that in order to cancel out some of the idiosyncratic risk of the market where you have your edge in, where you have more knowledge than the average market participant, where you expect to outperform the average. So there's a cost, And there's a benefit to diversification. The benefit is obviously reducing risk, right? Because one individual asset might move like this, the other asset might move in contrarian ways. When you buy both assets, this cancels each other out. So you've got overall lower portfolio volatility by simply buying lowly correlated assets to one another. So that's the advantage. The disadvantage is that you usually give up on market edge because your fifth good idea isn't as good as your best idea, but also because you cannot necessarily track that many different assets. So let's say you're in the crypto market and you buy, instead of say your top 3 or 4 cryptos, you buy 20 in the name of diversification. How likely is it that on your 20th investment, you're still as much deeply informed compared to your best investment where you're always following everything? How likely is it that you're going to follow 20 different Discord groups, 20 different projects with Twitter announcements? You follow 20 assets in that much depth that you're still ahead of the market. How likely is that? It's very unlikely, right? You have to concentrate your efforts, your time, your research on a few assets if you want to generate alpha. That's where you have to then concentrate. So you give up on the benefit of risk mitigation by being somewhat concentrated. But on the other hand, you also materialize then on the alpha that you have. So there's a real balance to be made. When you look at this just quantifiably, when you look at, for example, the stock market, when you buy stocks from different sectors, then you get roughly already the same kind of volatility as an index ETF once you pass the threshold of 8 stocks. So everything beyond 8 stocks isn't really reducing your overall portfolio volatility in the stock market anymore. My personal approach isn't even to buy 8 stocks. My personal approach is always that most stocks underperform the index, most cryptos underperform Bitcoin, most properties underperform the very best well-in-demand properties. So I always have concentration of gains in a few winners. The winner takes most in most capital markets. And because of this at least 80-20 rule, if not 90-10 rule, because of all of the profits going to very, very few players, you don't have to spread too wide. And if you can't identify the winners, then simply just buy the overall index. Because if you then still start to individually stock pick, the likelihood of you not getting the winners, if you don't have the knowledge edge in a market, is very, very high. So if you just randomly pick 10 stocks, the likelihood of this underperforming just the stock index ETF is super, super high because of that concentration. Most of the gains are super hyper concentrated in just a few assets. So always spreading your risk is not necessarily the best idea. It's a bad idea if you have an edge in a market. It's also a bad idea in very fresh new markets where the winners have to crystallize themselves and where most losers still have to be weeded out. Right, in tech, for example, this concentration effect is even stronger than, say, in traditional markets, because in traditional markets you already have very well-established players. So always think about this. How do I want to position myself in a market? First of all, you want to be invested in all markets, but you probably don't want to try to beat every market. You have to pick the one market, if you even want to pick one market to outperform, but the maximum you can probably outperform is one market. You have to pick that and you have to totally focus on that. For everything else, just try to go with the flow. Don't ignore those markets to get this diversification benefit, but don't think that just by diversifying across 20 different assets within a single market that you're achieving any kind of advantage. You're not achieving any risk mitigation advantage because of the high correlation within the market, and you're also not achieving any kind of alpha because you're washing away all of the alpha by being widely spread so far. So yes, for beginners especially, because you want to protect new entrants, not putting all your eggs in one basket makes a lot of sense. But if you get advanced in a market, you should be okay to focus your capital on the few winners that you strongly believe will outperform. But as said, you need to have an edge in there, right? And most people don't have an edge in a market. And usually, if you're lucky, you can generate an edge in one single market, and that's about it. I haven't seen anybody that has been able to outperform property and precious metals and currency and crypto and stock and all the markets, right? Agriculture. I haven't seen anybody doing well in every market. People normally achieve their outsized returns in a single market, and once those returns are high enough that it's worth to spread the risk and preserve wealth, then you take some of that capital away and you simply just mirror the overall market returns somewhere else. And this can be buying a bunch of different things, but this can also be simply just buying the leader. In the stock market, I'd simply just buy the ETF, ideally a tech ETF, because tech tends to outperform the rest of the market. So QQQ is my thing. So simply just a low-cost ETF. And for crypto, I have mainly my exposure to Bitcoin, even though I feel very fit in crypto. I don't feel that fit to identify the one altcoin that shoots up the next week. Right? I feel fitter in identifying within this vast oceans of underperformers what kind of altcoins will do worse, and then I simply bet on falling prices of those. I try to always stack the odds in my favor. I don't try to, when the odds are 1 to 100, to be that one person that picks the right winner. I rather pick 5 among the 99 losers and bet on those underperforming. That's what I do in the stock market. That's what I do in the crypto market. It could also work in the stock market, but the stock market unfortunately is a bit more efficient. But this is how you can generate alpha comparatively easily. So that's the idea around diversification. Don't always diversify. It's simply just a hedge. Make sure that when you do diversify, that you do this across asset classes, not necessarily within one market. That diversification usually has very little effect. And pick that one market where you believe you have an edge, because this is the market where you put most of your mental capacity on. Then simply just zoom into that market, zoom very deeply in, and try to beat everybody else, try to be the best in that market. If making alpha, if generating alpha in any market is even your thing. If it's not, they can simply just focus on your career and diversify across all those different asset classes and pick the winner or the index, and then you're fine as well. Simply don't think that you're safe just by buying 100 cryptos or 100 stocks. That's unfortunately not how it works. You have to go with markets that are lowly correlated. You have to go with assets that don't influence each other's performances that much, that don't have that many comparables, so to speak. Looking forward to see you in Telegram. There's a link down below. Chatting with every member there. So see you there and cheers.